Railroads have a strong competitive advantage or moat due to their high barriers to entry, like the significant cost of building and maintaining rail infrastructure, which limits new competition and preserves their market dominance. In 2010, Warren Buffett's Berkshire Hathaway bought the country's largest rail company, Burlington Northern Santa Fe Corporation, for $26 billion, paying a premium of 31.5% over the closing stock price when the deal was announced. The railroads are more energy efficient and use less fuel than trucks and can carry things that cannot go on the roadways like hazardous chemicals. What's going on? I'm Russ, a passionate passive income investor, sharing some research and information with you, as always, for fun and entertainment. Why? Because you should not be taking financial advice from a welder on YouTube. So we have for you, dear dividend investing viewer, a handy dandy spreadsheet analysis of the 5 publicly traded railroad companies here in North America, where you can find the link for this free spreadsheet in the description below. And if you'd like to keep up with all the portfolio moves we make in a free weekly newsletter, be sure to sign up at DapperDividends.com. So reading through some of the analyst reports, I kind of got the same feeling about all these 5 railroad companies, which is that investors can be hopeful about better rail service and efficiency improvements, but concerns still persist about derailments, disruptions, slow growth, increased costs, and potential regulatory changes that can impact the financial future of these businesses. So here's the handy dandy spreadsheet for you. If you hover over the ticker symbol and click, it will take you to the summary page, and you can see quite a good amount for free. I didn't log in just to show you what you can see for free, so you can get a good amount of basic data without even having to be a member. But if you did want to join, I highly recommend it, and I have an affiliate link with a special discount for you in the description. Below the company logo, we have for you the simplysafedividends.com score. Now, this is a paid site. We do pay a bit of a pretty penny. So this 85 very safe, if you wanted a refresher on what these scores mean, click this link, and they'll give you a breakdown of exactly what these dividend safety scores mean, with a whole bunch of other things trying to get you to sign up for their service. And then below the safety scores, we have the Morningstar star rating and the latest fair value as of the recording of this video, which all of this information is accurate. So for CSX Corporation, 3-star rating, $32 fair value. And remember, there is no exact fair value. It is all just an opinion and an educated guess. Now, most of this is self-explanatory. We have the dividend information right here, the current yield. And what we did with these green and red boxes and even the blue is this is all compared to the company. So in this column for CSX, this is all just compared to themselves. And the way you look at this is their current dividend yield. Is it above or below the 5-year average, as we have it detailed there? Currently it's 7% above, so we give it a green tick. The free cash flow payout ratio, very important. I think it's more important than the earnings per share payout ratio. Currently 28% for the trailing 12 months. That's what the TTM means. And that free cash flow payout ratio currently is 44% below the 10-year average for CSX Corporation, so we give that a green tick. And remember, I did this hockey style with a plus minus rating, which will be at the bottom. You can see the 5-year dividend compound annual growth rate, price to earnings, very self-explanatory. The revenue, sales, what the company's doing. Currently CSX 14.7 billion. So is that above or below the 10-year average? Currently 21% above. Very good. Now the sales growth for the last 12 months is 1%, which is 67% below the 10-year average. So that's why it gets a red tick, because we want to see that higher. Free cash flow, it's kind of the ugly truth number, right? CSX currently $1.54. Now I think where this can be helpful is you can't just look at Canadian National Railway and say, hey, they got $5.49 of free cash flow. That's much better than CSX, because the free cash flow per share currently for CSX is 83% above the 10-year average, while for CNI is only 50%, which is pretty good. good. But it just goes to show you, you're going to have to do a little bit more digging than the exact numbers that you see. But we want to compare these businesses to themselves for things like that. Shares outstanding, we like to see shares being bought back. So under management profitability, are they buying back shares? Over the last 10 years, CSX has reduced their shares 33%, CNI 21%. The only one that got a red tick was Canadian Pacific. They've increased shares slightly, 6%. Return on equity is going to tell us what kind of a return is management getting on shareholders' equity. And then return on invested capital is the return on all the equity and debt available to the company. So return on equity currently 31% for the trailing 12 months for CSX, which is 29% above the 10-year average. So both of these are good, which you want to see in the mid to high teens, because it means that management is earning money and plowing it right back into the business to keep that growing and compounding our investment. And then the last one is all about the debt. Debt is important. So are they above or below their debt levels for the past year? Looking at net debt to EBITDA, yeah, this is something that Charlie Munger calls bull earnings, but 2.39 means that it's going to take 2.39 years of earnings before interest, taxes, depreciation, and amortization to cover the net debt. Now this one was so close, 0.40, less than 0.5%. I called it almost even, give or take. Net debt to capital, 60% for CSX, which is 13% above the 10-year average. So we'd like to see the debt metrics below the 10-year averages, which for most of these, they were coming up a little bit short. And then the interest coverage ratio, you know it, we love it around here. How many dollars of operating income does the business have to cover every $1 of interest expense? And most of these, they were below the 10-year average, which means that it is a compressing margin, probably from higher interest on the debt or added debt too. But either way, CSX was the only one that was green at 4%. So you probably guessed that after the end of it all, CSX was first, Canadian National was second, CP was third, UNP, Union Pacific fourth, and Norfolk Southern fifth, which is interesting because Morningstar.com gave Norfolk Southern a 4-star rating, the only one that had 4 stars. So hey, that's their opinion. This is just a little experiment we ran comparing each business to themselves, Dapper Dividend style. And then at the very bottom here is the investor relations page, which is really important. So if you hover and click, it'll whisk you away to the investor relations page. And I would highly recommend clicking on financial reports. You'll always see a drop down, SEC filings, and then you're going to look for the annual reports, annual filings. And in that, you want to look for the 10K, the annual report. And when you click on that, it may seem daunting, but there is everything you need to know from the horse's mouth, so to speak, filed with the SEC that will tell you everything about the business before you invest. So take it for what it's worth. We got a +9 for CSX. So that looks like the Dapper Dividends pick out of all of these. Again, you would need to do your own due diligence, whatever that means for you, to determine if you wanted to invest in one of these. We'd love to know which of these you own, or which one is your favorite, or which one you might be interested in investing in the comments below. And in this floating little box next to my head, we have selected for you 10 cheap dividend stocks with a little bit of a twist. They have high insider ownership of at least 20%. So if you click that video, I'll tell you all about it there.